Hello friends, Chris Lee, CPA here, back with another video for you. And today we are going to talk about state taxation of trusts. And so usually trusts, when we're thinking of wealth planning or transfer taxes and all those sorts of things, we are using, trying to treat the trust as, a resident of a different state to, minimize or avoid tax at the state level. So when it comes to taxation, we have to consider both federal taxes and state taxes, and higher tax states and higher tax jurisdictions can be, a meaningful drag on the wealth transfer. And so we're going to talk about the state taxation of trusts today. So just to, to a reminder, trusts, as we all know, are, useful tools in estate planning and estate tax planning. And, in certain circumstances, they can offer liability protection, assuming that you don't have access. Assuming the grantor does not have access to the assets, there can be some amount of liability protection for those sorts of things. And so we have to think about the benefits definitely are going to outweigh the cost when it comes to trust. So trusts, as we all know, come in many different colors and sizes and those sorts of things. There can be, at the fundamental level, there's, irrevocable trusts, which means they can't be changed, and revocable trusts. And then, then they're categorized as grantor and non-grantor trusts. So on the revocable trust side, they're pretty much always, grantor trusts, which is to say for income tax purposes, estate tax purposes, they do nothing for us. They're disregarded. Nothing's really changed. They're really just an estate planning tool, not an estate tax planning tool. And they're not an income tax planning tool either. Everything is treated as nothing happened for purposes of income tax or estate tax. Now, when it comes to an irrevocable trust, we do have we can have an irrevocable trust that is grantor, which is, disregarded for income tax purposes, but regarded for estate tax purposes, or we can have them be non-grantor. They're totally a regarded entity. It pays its own tax, all those sorts of things, So those non-grantor trusts can have some additional, classifications as well, because once you are a non-grantor trust and it's a taxable entity, then we also have these concepts of what is a simple trust or a complex trust, which is to say, a simple trust pays out all its income currently, and a complex trust, it can accumulate assets and wealth along the way. So when it comes to trusts, they're, when it's, a non-grantor trust, they're all going to be, subject to federal income tax obligations, or at least filing obligations. But at the state level, it's interesting because trusts can actually be taxed in multiple states, depending on where the assets are held, the income is generated, the location of the grantor, the person funding the trust, the trustee, the person administering the trust, or the group of people administering the trust, or it can be taxed based on where the beneficiaries are. So that's the thing when it comes to trust, because it is a function of, contract and law. There are, it becomes a little innocuous in determining where does this actually even get taxed, and if you've got assets in multiple jurisdictions and all those sorts of things. So what we really need to think about is when we're talking about a non-grantor trust, a regarded trust, we need to understand the resident state or the non-resident state of the trust. And so the difference between a resident and a non-resident trust lies in how the income from that trust is going to be taxed. So a resident trust is going to be taxed on all of its income, regardless of where it is sourced or earned, in a general sense. In contrast, a non-resident trust is only going to be taxed on income that is sourced to that specific state. So this is where the planning usually comes in. We want to create oftentimes, that residency status in a jurisdiction where there is no income tax. So we need to understand what are the triggers for residency, and that's all going to be different, based on different states. So It is also possible that a trust can be a resident of 2 states at the same time. So it's taxed on all its income in 2 states. That's one of the most important things to avoid for efficiency purposes. Now, there are some states that do have mechanisms to kind of fix that. It's called reverse credit states, all those sorts of things. But in general, we want to avoid that sort of thing. We want it to be cleaner and to organize things in such a way that that's an issue of voice. So when it comes to state taxation of trust, it's really going to depend on the state law, which is, kind of a complicated analysis because everyone does everything differently. But the common considerations of this are going to be, based on the type of trust and how it's created. So when you have a trust that's created by will upon death, a testamentary trust, for the trust created under that scenario, which is created under a will, the domicile or residency of the testator, the person that is creating a will, is often how the residency of the trust is going to be determined. When it comes to a trust created not by will but during someone's life inter vivos, the trust is possibly going to be determined by where the grantor lives, the person that is funding the trust, instead of putting assets into the trust. Another potential factor is going to be the trustee, which is the person that's administering the trust, the fiduciary. The state of residency of the trustee could end up being the state of residency for the trust. This is, going to be the case for, Oregon or New Mexico. Then there are states that look at the beneficiary's domicile or residency. So if you have the beneficiaries which receive the benefits of the trust, benefits of use or income from the assets that are held by the trust, the domicile or residency of beneficiaries of the trust could also be that determining factor. This is California, Hawaii, those sorts of things. There can also be where the trust is administered. So this can be, the physical documents, right? So administration of the trust can also be residency. It's important to know that the term administration can be different and vary from state to state. So it's important to understand the statute. And so then the last piece is the location of the trust property. So in a few states, the location of the trust property can also determine the residency. This shouldn't be confused with the sourcing of trust property or income for income tax purposes. So income tax purposes could be different for and it should be recognized that for trust property, it can be different for non-resident trust versus resident trust. So that's another thing to think about is the location of the trust property. So in each state, it's going to be different. And some states may use a singular factor or a combination of factors. And this is, in essence, kind of how it works from a multi-state taxation perspective as well. When we think of, a business, right, we think of people, property, and sales. So where are your people located? Where are your property located? And where is your so where are your people, where are your property, where are your customers? Customers are clients. And so those are the three factors. When we're thinking of a trust, we can have those sorts of factors for individual pieces of income, but we're thinking of the residency versus non-residency question. We're thinking of who forms the trust, who administers the trust, who benefits the trust, and the assets of the trust. And so that's basically what we're thinking of when we come to determining the residency of a trust. Now, when it comes to a trust and it's considered a resident trust, all of its income is going to be taxable in the state of residency, regardless of where it's derived. Some states offer certain exemptions, even though it is a resident trust. So New York has kind of an interesting rule that says, even if you, pass the rule where it says that the residency of the grantor, so the person that funds the trust, is a resident of New York, and then the trust will also be treated as a resident of New York. However, it can be exempt from taxation in New York, even if the trust has, if the trustee is not a resident and there's no beneficiaries of New York that are residents, that the income, even though the trust is a New York resident, that it's going to be exempt. So you still file that return with New York, and then basically just say we're exempt from income tax of New York for this reason. So that's something to be aware of, is that there can be exceptions to these residency rules as well. When there is double taxation, there's usually a relief mechanism, and this can be in the form of, tax credits for taxes paid to other states. Now, it's interesting when it comes to the taxes paid to other states is usually it's only up to the amount of tax that the resident state imposes on that income, rather than for the total tax paid in their jurisdiction. So that is to say, if you have income that is sourced to two states, taxed in a non-resident state, and then also all income being taxed in a resident state, that you could, and the non-resident state has a lower tax rate than the higher tax rate. The higher tax rate jurisdictions only give you a credit for the portion that you paid to the other state. And so in the resident state, you could still have a differential where you're being taxed, what is functionally a higher effective tax rate due to it being a higher tax jurisdiction, and only getting a credit for the lower taxes you paid in the other jurisdiction. You're not getting, an offset because that income was taxed. That same income is taxed. You just paid, say it's a 9% state and you paid 4% non-resident tax. Now you've still got a residual 5% to pay in the resident state because you only get the 4% credit in the other jurisdiction. So that's one thing to think about when it comes to double taxation relief, is if your resident state is a higher tax state, you could have some issues. If your resident state is a lower tax state, say you have some property in California and you're a resident of, say, Indiana or something like that, where it's, a 3% state income tax, what's the consequence here? You 3% state, 2% county, so 5%. You pay 9% in California, you only get a credit in Indiana up to what the state would have imposed tax, which would have been, approximately 5% or something like that. So you've had an inefficiency of 4% in that non-resident jurisdiction. So when it comes to planning for this state tax exposure, that can be done at the, we're really going to do this when the trust is created and administered. So you need to avoid having multiple grantors to the trust to mitigate exposure in more than one state. So if you've got multiple grantors into a trust, you have multiple potential states of residency, right? Like if you've got states that are determining it based on the grantor, and now you've got, multiple people being grantors of the trust, you've got a potential issue. So since many trusts include the residency of the grantor as a trust, one grantor per trust can help kind of prevent that double taxation issue. Now, we also want to think about one grantor per trust, and we also want to have separate trusts for separate beneficiaries. So this yields a few benefits, but especially in the generation skipping beneficiaries are involved, you can also minimize the risk of multiple states taxing the trust. So one grantor, one beneficiary. This kind of the one beneficiary kind of plays out in a lot of ways. Also, if we want to avoid having our trusts treated as a singular trust, if you've got multiple trusts with multiple beneficiaries and they're all the same, but you kind of set up different assets in the trust or whatever, what you can happen is you can have all the trusts collapse down into one, potentially for certain income tax planning issues. And this could be QSBS, qualified small business stock exclusion benefits that we might be trying to maximize. But if you've got same grantor and same beneficiaries and multiple trusts, they can be collapsed for income tax purposes. So not only do we want to have separate trusts and separate beneficiaries for a lot of income tax planning purposes, we also want this for our state residency tax planning purposes as well. And then the grantor or non-grantor status of the trust, whether it's grantor or non-grantor, it can change the analysis. The rules aren't applicable to grantor trusts in most states. In a grantor trust, all income is taxed solely to the grantor, and the grantor is the natural person and where they are residency. So what we need to recognize is that when that grantor passes and that trust becomes a regarded trust, then we are going to have some issues that we'll potentially have to deal with on the state of residency. So when it comes to where the trust will be administered, usually people will choose, these tax-free states like Florida, Nevada, Tennessee, Texas, Wyoming, all those sorts of places that don't have income tax, in order to kind of get that trust, to help promote the narrative that this trust is in a non-tax jurisdiction. Totally fine, it makes total sense, but it doesn't always work that way. So it can be a good tool, but usually if we're setting up these trusts and this is kind of a goal that we're trying to achieve, we're going to have some sort of trust administrative services outside of our typical attorneys that might be pulling the documents together and that sort of thing. It's also important to know that like a state like Washington, even though it doesn't have income tax, it does have a capital gains tax, and a lot of times these trusts are used for highly appreciating capital gain assets that we're trying to get out of the estate, and putting those assets into a state with a capital gains tax like Washington is kind of counterproductive to our to what we're trying to create here. And so I say that, just be aware that like just because it's a non-tax state doesn't mean no income tax state, that doesn't mean that that's the right place for us, because usually the assets held within a trust, and particularly quote unquote a non-grantor complex trust, are going to be capital gain assets. We don't want to put it into a place with high exposure for capital gain tax. So just keep that in mind. So this is kind of just an intro taste as to like how we determine where the state of taxation is going to be for a trust, and that it is really a strategic decision, right? Like, and depending on the size of the assets and the amount of income we're talking about, that being smart on this can make tons of sense. So this is all to say, not all trusts are created equal. So you need to, determine and plan for the state of residency and those tax consequences when creating and administering the trust. So this is a front end thing, not a back end thing. So there's going to be several factors as discussed that are going to determine that. And so those factors are, the grantor, the beneficiary, the trustee, the assets, in the administration of the trust. And so those factors, depending on the states in question, will have a different combination of outcomes. So that is to say, if you've got a question on this, or need to discuss other income tax or estate tax planning questions, certainly feel free to click the link down below. And yeah, looking forward to connecting back with another video in a bit. Take care. Bye.